This video is for investors only. So if you want to buy a stock, we will learn how you can use options to optimally buy that stock better. But remember, this is not a trading strategy. It's for large investors. Basically, here's the summary. If you want to buy a stock at 100 and you're convinced it's a great stock, but you think it's a little expensive, this stock should be at 90 and then I would be a buyer, and you're ready to invest in it very, very long term, you are a value buyer, then there's a way that you can actually purchase this 100 rupee stock for much, much less. And today we're going to discover how we can do that using options. So let's start with step number 1. But before that, please hit that subscribe button so we know you love us too. In this video, we're going to first talk about what a cash secured put means. 2, we are going to talk about the different scenarios. If the market goes up, stays sideways, or goes down, what happens to your P&L? And 3, what are the risks and other things involved in an investing, I won't call it a strategy, well, let's just call it a strategy. So step number 1, you need to find a stock that you believe in, a business you trust, and you want to invest in over the next, say, 7 to 10 years. I'm not going to tell you what company that is. That's your problem. But I'll assume you want to buy a certain company, blue chip company, I hope, for the long term. Another condition is that you think the price is slightly higher, and as an investor, you'll always want to buy something lower. So for this example, I'm going to pick Tata Steel. I'm going to pretend I really believe in Tata Steel. I don't, but I'm going to pretend I do, and I want to buy the stock at 120. Wait, I think 115 is a little more fair price, or 112 is a little more fair price. 120 is a little expensive, but I really, really believe in Tata Steel. So that brings us to our step number 2. Step number 2. If I bought a call, I would be bullish. If I bought a put, I would be bearish, which means I think the market's going to go down. So we're going to do the opposite. We're going to sell a put, or we're going to short a put. A short put basically means you are bullish on the stock. So now I need to short a put, and I think 120 is a little high. So I think, say, 117 is more fair for me as a long-term investor. It'll be a different number for you because you have a different company, different belief. We short put at 117 at around 2.5 rupees ka put. And remember, when I've sold a put, I have unlimited losses, theoretically, but limited profit. In this case, it is 2.5 rupees multiplied by the lot size of 5,500. So when I sell this put, I will receive about 13,000 rupees premium in my account. Now, in only 2 scenarios do I get to keep this 13,000 rupees. Actually, one scenario, this 2.25 rupees or 2.5 rupees ka premium should go to 0. If it goes to 0, I get to keep the money. Step number 3. Now straight away, let's imagine we've gone to expiry date. So let's look at a payoff chart to see in what scenario do we lose money, in what scenario do we make money. So Tata Steel, which is at 120 right now, when Tata Steel is at 115, it is break even for us. Notice we start keeping the most money at 117 and onwards. So if we go from 117 to 125 to 140, 150, etc., we keep going up from there. We get to keep that 13,000 rupees premium with us. It's a profit. However, the moment we start going below 115, we start losing money thereon. And the more it falls, the more money we lose because the value of that premium goes up and we lose some money over here. But we've not actually lost. As a Tata Steel long-term investor, the strategy is very simple. When the market falls down, suddenly the long-term investor who wanted to enter at 120 now has the opportunity to enter at 115, 110, or whenever the price goes down. You will lose a little bit money on the put, but you are getting entry of your favorite stock at a lower price. And that's why you have to think of this as yourself as a winner. In most scenarios, 3 things will happen. The markets will go up, in which case you get to keep this 13,000 rupees. If the market stays the same and goes sideways, again, you get to keep the premium. That's 13,000 rupees. And even if the market goes down just a little bit, because there's no momentum, the put will expire to 0. And again, you will make 13,000 rupees. In all these three scenarios, you'll actually make money. And as a long-term investor, you lost it, right? Because you would have invested and nothing's happening. There's no action in the market. Only when the market goes down really fast do you lose money. But think about it. This is cash secured puts, which means you have the money to buy the stock. So you can simply close that position at expiry, buy the stock as you wanted to, and hold on to it for the long term. So I think, imagine 4 months go by and the market goes up a little bit. Second month, the market goes sideways. Third month, market goes sideways. Fourth month, market goes down a little bit, but then goes sideways. In all those 4 months, your Tata Steel didn't give you returns as an investor, but because of the puts, it gives you some return. Think about it from the mindset of an investor and not a trader. Another way for you to think about this is, if you thought this was complicated, just go and buy the damn stock and don't do any of this, because who cares? But for people who want to optimize their entries and their portfolio, this is a great way to do it. It's going to take a little bit of your time, but well, thank me in the comments that I showed you a new path for this. So not only did we generate some money when the market was sideways or went up a little bit, we also bought our stock eventually once it fell down and gave us a great entry price. But there are two risks. Remember at the start of the video, I said I will talk about the two risks in this strategy, and here they are. The first one is not really a risk. It's more of a औकात क्या है तुम्हारी? You have to take the number of the lot size, that's 5,500, multiplied by the share price. इतनी औकात आपकी होनी चाहिए. If you're not able to buy and take delivery of that large an amount, you really can't execute this strategy because your lot size should match the money you have in the account. And then there's, of course, you can only select stocks that are in the F&O segment. You may find a stock you really like, and that's not in the F&O segment, so this strategy can't be used there. Or even worse, that stock does not have liquidity in the F&O segment. Please make sure you do this with the liquid F&O segment. Anyway, the second risk is this. In case Tata Steel goes to 150, 160, 170, you never entered as a long-term investor at 120. So that's a loss you'll make because the profit you make on the put is just, well, the fixed premium you sold, which in this case was around 13,000. So that kind of sucks. So in this scenario, you'll take delivery of the stock. So basically, as a long-term investor, even when the market was doing nothing, you're able to make money. Only when it really fell down, well, even in that scenario, you lost a little bit on the puts, but you were able to get your favorite stock at a lower price. If you like this video and you really want to get your hands dirty with options, because frankly, watching a video is not enough, you need to sit with someone to understand how this works with real trades, we have something called Option Prime. Go to the link in the description, fill up the form, and actually learn how options work over a 2-day period. I promise you, it's great because you're not watching a video, you're with a mentor, with 30 other people in a group, and you get to build stuff together, and that's the only way to learn a skill. Anyway, if you found this video was nice, smash that subscribe button and watch the blooper scene right at the end. See you in the next video. Now comes the video. Hi guys, that's tonk. Another way for you to think about is, itna matha pachi nahi karna hai, just buy the damn stock. But oh fuck, not again.